Hey everybody, welcome to Trading Capital's daily analysis video. I'm your head market analyst here, Curtis Scouten. Jumping into the charts on this December 21st. So the markets did finish positive today, up over 1.5%, but it was another very light volume session, 77.9 million on the session. And now this is where the interesting part of the market is going to take place. Are we going to continue to float up and potentially fill this gap? Or is this initial support level now going to be resistance? You can clearly see that we're coming up to this big resistance zone here. You have this big pivot over here, so you have these two little pivot areas which should act as resistance in the near term. You've also just slowly pierced above the 50-day and filled this technical gap today on the daily charts, which is a short-term positive for the market. However, let's not forget that this was a very heavy volume sell. So the little buy volume pressure, yes, it is finishing and causing us to float up, but it's more due to a light volume session, and it doesn't really show the real conviction trend of the market. Due to the fact that this was a much heavier sell-off on heavy volume, the trend, in my opinion, is still broken, especially since you broke and confirmed this bullish consolidation pattern over here. Now, I still think we have to go test the downside, 371. There's still tax loss selling that can occur. However, if the markets continue to see this light volume, buying pressure without much selling pressure, then we could see that float upwards or even a little bit of a sideways chop. Now, considering you have filled this gap to the upside, you still have now 1, 2, 3 gaps to the downside, which again are kind of like that magnetic pulling the price action down. Most gaps are meant to be filled, especially when the major trend is in favor of the direction of those gaps. So again, we do have a gap to the upside, but it's less likely to be filled, in my opinion, because of the heavy resistance that we're running into, as well as the major trend of the S&P, which is down. Taking a look at the IWM, small caps are generally a good leader for the overall economy. You can see the IWM has also hit a bounce. Basically, where I see the IWM retracing to is this breakdown zone. Let me just erase some of these trend lines over here so we can get a little bit of a cleaner picture. Basically, you hit your support level, actually pierced through it and bounced over it now, but you're coming into this big breakdown point, arguably your gap and then your confirmation. So this red trend line is going to be acting as major resistance, which also could coincide with this pivot. Now, there is the potential again that we float all the way up to 179, but realistically it's not that much more upside in terms of where the resistance lies. There's still a gap to the downside, and ultimately I do think we will break that double bottom zone on the IWM. Let's take a look at the US dollar. So right now the US dollar is showing some intraday accumulation patterns. Even on the back of that big Japanese interest rate hike and the complete strength in the Japanese currency compared to the US dollar still did not take out this low at 103.40. I think this is the short-term low for the dollar. You can see why I'm saying that. It's a major technical area around here. You have this previous breakout resistance zone, check back as support, and then breakout, and then also a little bit of a check back. Plus you have this pivot going back in March 2020 as well as December 2016 area. So this level is a huge support zone, in my opinion. Even if this doesn't hold, underneath that you even have a little bit more of support just waiting. But it's really interesting to see if the dollar is now putting in a series of potential higher lows. So yes, we haven't taken out any of the highs, but now we've had 1, 2, 3, 4 days of higher lows, and that could be the starting of a potential accumulation pattern that is occurring in the dollar. Now, one of the reasons I still think the dollar can go higher, if you simply look at the correlation to gold, gold has hit its big resistance level, and I do think that we're going to see sellers emerging in gold. Also, if we look at the 2-year yield, the long end yield, so the 10-year yields were actually causing a little bit of a divergence today. Yields have still technically in the short term arguably broken out a little bit. Now there is resistance around this trend line around 3.76%, or give or take the 50-day moving average, which I do think the yield market will at least touch. So if we're seeing the stock market rally and yields have actually made a significant rally and a potentially short-term breakout, that is a negative divergence for the stock market. We've seen that multiple times this year where bonds will start to get basically put under pressure because of higher interest rates, and that's when you typically see the stock market eventually start to roll over as that liquidity is being sucked out. The bond market is still the most important market to watch and analyze, and when liquidity is being sucked out of the bond market, it's very rare that the stock market doesn't follow that same pattern. So I do think that is certainly something interesting to watch, considering that it looks like this 20-year yield can actually probably retrace all the way back up to 4.15%. And even if the 2-year yield stayed around this level, that would mean that the yield curve inversion is slowly compressing and coming back to more of a neutral stance. It would still be negative according to this in the 2-year. However, it would start making progress to coming back to some sort of a normalcy level. But every time you have that yield curve inversion come back to normalcy, that's usually the start of a significant recession and a headwinds for the markets. Let's take a look at silver. We are shorting silver, just a small position. One of the reasons we're shorting silver, if you simply look at this beautiful channel that it's in, silver has had an epic run, basically tagging the bottom of this range, now trending to the up of this range, or the upper boundary of this range. I think silver at the minimum is going to see a retrace, likely back down to this breakout zone. So perhaps it intersects with this highs around 22.40 or perhaps around $22 and change. 22 may seem like a decent level, or even this 21.40 level. So anywhere between 21.40 and 20.22, so about a dollar range, is probably going to be a big level for support on silver. If silver goes higher, we'll look to add to our next level around the $26 level, and then ultimately these pivots over here. But right now, I'm comfortable with our short position, and we'll just likely see a meaningful retrace in the near term, especially if the yields in dollar surge. We will see those metals kind of take a breather, considering they've been the outperforming assets over the last month. Let's take a look at, I just want to show you the Japanese and dollar market. So the US dollar JPY, basically this was that massive sell-off on the Bank of Japan raising rates, which arguably put a lot of pressure on the dollar. But you can see that one of the reasons why this is such an important level, you can clearly see it hit major pivot, and pivot over here, and it is holding this technical level. Due to the fact that it is oversold in the short term, you would naturally expect somewhat of a retrace. You can probably expect a retrace to happen in and around this upsloping trend line, probably maybe back to this 137-ish area, and that should put a little bit of pressure on, or a little bit of upside pressure on the DXY, as the Japanese yen is anticipated to potentially soften. Now, there was some interesting news. Let me just flip to the oil chart. Not on oil, but in regards to Canada. Canada CPI today came out with an uptick in inflation. The first uptick really since basically we've started this tightening phenomenon, and really since the inflation rate has abated from the highs. But it's not good to see inflation starting to tick up when in an environment where the central banks have been raising rates aggressively and tightening monetary policy. So in history, we have never had inflation abate and come back to the norm unless interest rates went higher than the inflation rate. So that is a crazy phenomenon. That's why I do firmly believe we're going to have an engineered recession or deflationary crash or bust, because there's no way, mathematically speaking, that you can keep trending lower and reach the 2% target if inflation doesn't go well below 2%. So it's just a simple mathematics calculation, but reverting to the mean means something has to significantly stretch again out of that equilibrium zone. But essentially for oil, and again, why I'm mentioning the Canadian CPI, I'm not saying the US will uptick, but it begs to question that those economies follow in similar fashion. And if the Canadian economy is starting to uptick in its inflation, then we could start to see similar areas of the inflation readings start to uptick as well. Like food was the big increase for the Canadian, 1.2% month over month, which is a drastic increase, and it's certainly not what central bankers want to see. Looking at oil, oil's on watch for a short-term breakout. If oil confirms tomorrow, it likely heads to the top of this range around 83.84, maybe connecting with these pivots. I haven't decided yet if I'm willing to short oil at those levels. I'll just have to really wait and see what type of pattern starts to form. But potentially we could see, and this is just a lot of speculation, but potentially if oil rallies all the way up to somewhere around here, pulls back, and then starts to form a little bit of a base, that might be a potential opportunity to play a little bit of an inverse head and shoulder, which does probably point to a much higher oil around this $91 area. Now, this is very speculative. It's just me kind of thinking out different scenarios. I still think the more likelier scenario is that even if we do get a breakout up here, we start to see it trade all the way back down to the $66 or $68 barrel an area. Natural gas basically having a little bit of a bounce yesterday and then or today, and then this is the new candle. So basically natural gas is holding up at that support level. I still think if we get a retrace back up to this neckline, that could be an area of opportunity to pull the short trade. Now that is a little bit of a high riskier trade considering that it is significantly off the lows, despite I do think we're likely heading to $3.48 sometime in the first 1 to 2 quarters of the new year. Really, that sums it up for today's video. Obviously, the market's caught a little bit of a bounce, so our portfolio was slightly down. But I do think that we could either, I don't think there's much more upside in this market, especially on the S&P 500. I do think that there's still more likelier outcome to trend lower, and we'll just have to wait and see how we chop in this range. Whether or not we just start now consolidating bearishly, making a flag pattern, or if we start to just chop, head down tomorrow to fill this gap, and then maybe back up to fill this gap. But overall, let's just take it day by day on this light volume. Grind up, float up. I'm not really convinced of the buying pressure, not really deterred from the overall thesis that we still see lower lows on the chart. That's it for today's video. Please give it a big like down below.